Okay, so let's talk about, again, revisit. Now, I said this is an analog to my accounts receivable. It certainly is, where we have purchase discounts, right? Someone's trying to incent prompt payment. They're the seller. We discussed how that happens under accounts receivable. But of course, for every seller, there's a buyer. Now we're looking at it from the buyer's side. The buyer has the same choices. They can treat their purchases and the cash discounts they're offered in a gross method, where they record the full price, or net method, where they record the reduced price. And this is all under the periodic method, right? It's assume that all purchases are under the periodic method. Understand that if perpetual is used, then what happens is this gets replaced with, and I'm going to put it in blue, that just gets replaced with inventory. Inventory. Purchase discounts get replaced with inventory. The one thing that does not get replaced is this item right here. It's called, I call it interest expense here. It can be called purchase discounts forfeited, are not replaced with inventory, even under perpetual method. And if we did do that, if we did replace interest expense or purchase discounts forfeited, then we would be doing something that I said we do not do, which is we would be including purchase discounts forfeited or interest expense in the value of inventory. We would be crediting, or sorry, debiting the purchase discounts forfeited into inventory, which would include it in the value of inventory. So other than that caveat, again, I know the various systems start to throw a little bit of a wrench in these things. It is the same pattern that we saw in receivables. If we invoke the gross method, we assume we're not taking the discount. We record it at, it says the company purchased $1,000 of merchandise. It has 2% discount in 10 days. If it pays within 10 days, we act like, hey, we're not taking the discount. We're using the gross method. Oh, we buy within the, we pay the amount of money within the 10-day window. Then we get the 2% discount. So we credit purchase discounts if we're using the periodic method for $20. We only pay $980 of cash. We cancel out the full $1,000 that we had owed with only $980 because we're taking a discount. If we don't pay within the discount, then there's no special accounting needed. We pay the full amount with the full amount of cash. And again, under the perpetual method, all we do is replace purchases with inventory, and we replace the credit to purchase discounts with just a credit straight to the inventory account. And that would get it at its right value, because if we purchase it, if we buy or pay within the discount window, we're only paying for $980 of inventory. Under the net method, I assume I'm taking the discount, right? I record the inventory at the discounted price. I record the payable at the discounted price. When I take it, because I assumed I was going to take it, everything works out, right? The payable is at $980. Well, I'm only paying $980 because I'm paying within the discount. Over here, when we don't, right, when we violate that assumption, we don't take the discount. Well, we got to pay the full price, $1,000. The payable was only recorded at 980 up here. So I can only debit it for 980. I make up for that missing amount by debiting purchase discounts lost or debiting interest expense. The idea of debiting interest expense is essentially, I bought this inventory with a promise to pay. I didn't pay within the promised time for the amount that I thought I was going to get with the discount. I'm paying extra. And remember, a crude definition of interest is any amount paid over the amount borrowed. So basically, I'm charging myself some interest for not paying in a timely manner. It might just help to say purchase discounts forfeited. And again, I think McGraw-Hill likes this term better, but in practice, both are used pretty interchangeably. So let's look at, the example. It says record the journal entry under the gross method if Kyle took advantage of the discount under both periodic and perpetual methods. So we have discount terms 3, 10, and 30. We bought inventory. We're just going to apply the discount accounting to the invoice price, not to the freight. So we got a 3% discount on $120,000, which comes to $3,600. So if they paid within the discount window and they're using the gross method, then they would record a reduction to the full payable of $120,000. They would only need cash of 120 minus that amount. And the discount is going to be recorded as a purchase discount if we're using the periodic method. So that reduces the liability, that reduces an asset. Recording the purchase discount credits a contra asset, also reducing assets. If we're doing this under the perpetual method, then everything's the same except purchase discounts becomes a credit to inventory, but all the amounts stay the same. The other two accounts stay the same. And that would be the perpetual entry. If they had used the net method, we'd have to make a couple of alterations. We'd have to alter some of the original facts here, right? Under the net method, I would record this not at 120, but I would record it at 116,400. Even the return would be recorded at the net of discount price. And finally, if we paid within the window, we would have no purchase discount account because we would just be debiting the accounts payable already at 116,400 with $116,400 of cash. So there would not be any updates there. All right, I want to start with this discussion, and I'm going to push the due date of the next assignment just a little bit. We're getting a little bit clogged, and I pushed the smart book reading due date as well. I'll have to look at when assignment 9 is set to be due, but I definitely want to get one more lecture in before I have you guys do it and turn it in, because it's just getting a little bit like backlogged with the pace that unfortunately we have to set in the summer. But I do want to spend the remaining time just reintroducing the ideas of cost flow assumptions. So that way, we won't get into the weeds of calculating cost of goods sold and inventory under each one, but I want us to refresh and remember and also understand some of the theory that's behind them. And the theory is pretty simple. Under all methods, purchases are going to be the same. So cost flow assumptions only affect records of inventory sales. And so notice up to this point, we've avoided, like in that problem that I just worked, I said, hey, we're all on the purchase side of things, not selling anything yet. Because when we start to sell, then we have to make an assumption of exactly what inventory we're selling. The purchase is easy. I know how much I'm purchasing. I'm purchasing this unit at $10. I'm purchasing that unit at $12. I'm taking a 3% discount on the $12 unit. That's fine. But when it comes to the sale, right, that becomes a mystery. And that's why we have to make an assumption, because yeah, I bought some at 10, I bought some at 12, I bought some at 15, right? But when I sell something and I go to record the reduction in the amount of inventory that I should record because I've sold that inventory, it's no longer mine. When I record the increase in cost of goods sold, and I'm like, well, that one unit I sold, was it the $10? Was it the $12? Or was it the $15? And that's when my cost flow assumptions come in. So they don't alter purchases. Net purchases will be the same. They don't alter my inventory account. So the quantity of my inventory will be the same. That, it doesn't change reality. I go in and I count 10 units. 10 units are always 10 units. The question becomes, what cost do I want to assign to the 10 units that I'm counting? So we're pricing the ending inventory. So I say pricing the ending inventory, that's under the periodic method. And remember, under the periodic method, I have this inventory equation that gives me goods available for sale. I shorthand it GAFs. So what I'm looking for is this dollar value here. What is the dollar value of this ending inventory? That's supplied by the cost flow assumption. And so because it influences this number here, it also influences that number there. When I am doing this under the perpetual method, I'm assuming what I just sold in the transaction. Because remember, under the perpetual method, I record cost of goods sold with every single sell I make. And so I'm determining what is the debit to cost of goods sold for the item I just sold. When we're selecting a cost flow assumption, it does not have to relate to the physical flow of goods. So what that means, I always use the grocery store in this example, because the physical flow of goods in the grocery store is the oldest stuff, right? The stuff that is going to go bad first is sold first. They stock the shelves, right? Think about, I don't drink dairy milk anymore, but I remember when I was a kid and my mom would be like reaching all the way back to the back of the line to try to get the freshest milk, right? And because they want to arrange it so that the milk that came in, perhaps 2 days ago is the thing that will be taken first before the milk that just came in a day ago, before the stuff that just came in today. And when that's happening, the physical flow of goods is actually first in, first out, right? If you just buy from the front, you're buying their oldest purchases first. So it came in first, it came in 2 days ago, it's being bought today. And then the stuff that came in a day ago is bought. And then finally, the freshest stuff is bought. So the most recent purchases in that physical flow are bought last. The freshest milk should be the last to clear the shelf if the store is doing it right. However, don't matter. A grocery store can and does use LIFO. Doesn't matter that the oldest stuff is actually being bought first. They can assume whatever they want about their price points as long as there's a rational, systematic, and consistent cost flow assumption used. So for example, a company can't one quarter decide I want to use FIFO, the next quarter decide they want to use LIFO, and then switch back and forth and back and forth. That's actually called a change in accounting principle and requires significant disclosures and lots of calculations that make it rather expensive, literally and figuratively, for a company to enact. And of course, just to close it off, these are the 4 methods that are used. You got specific identification, and this is for, again, our low sales volume, high profit stuff. We're thinking diamonds, we're talking, like, since it's Texas, firearm sales, we're talking even cars, right? Low sales volume, not a huge number of sales every day, but when something's sold, damn, they make a lot of money. And we can identify each item that's sold. We know the car has a VIN, we can trace it. The firearm has a serial number, we can trace it. The diamond is cataloged, right? They can trace it. They know exactly what diamond's being pulled off the shelf. It ain't, reach into the bargain bin and grab a 10-carat diamond day. The other 3 are the ones that we use with high sales volume, low profit businesses. First in, first out, it's like an assembly line. As I purchase things, they move through this thing. So this was purchase, oops, so this is my, that's not large enough. If I have 1 day ago, 2 days ago, 3 days ago, they enter into a pipeline and they are purchased here. Oops, sorry, wrong side. Purchased and sold. So the oldest stuff is sold first, the next, purchased here, works its way through. I don't count the stuff I bought 1 day ago until the stuff that I bought 3 days ago is sold, and the stuff I bought 2 days ago is sold. Last in, first out assumes the most recent things are sold first. So it violates this whole pipeline idea. What I think about is, okay, so I have a couple of dogs, you've seen and heard them on the recordings, and they have a big bin of dog food. And let's say that I pour, some fresh dog food into their bin from the bag, and it fills it up. and I'm feeding them, right? And I get down to the bottom and there's just this little bit left. There's a thin layer of dog food at the very bottom. And if I don't scoop that out, if I just pour a new fresh bag, new purchased dog food on top of that, that old layer will still be down there. If I don't shake it up, it'll still be down there. And I'll just keep scooping out and scooping out and scooping out, right? I'll scoop out the stuff I added, the most fresh dog food first, until the very bottom. And then if I fill it up again before I feed him that very bottom layer, I'll just start dipping out of the top and getting the fresh stuff first. What could eventually happen is I have some super stale ass dog food at the bottom of that bin that I have never sold, because if I don't sell through the entire inventory, it was stuff I bought a long time ago, because I'm always giving them the freshest stuff first. Think about it with the grocery store. If they stock the shelves so that they always put their most fresh produce, fresh dairy out front, people would just be kept taking that. And if they kept replenishing it, they would never get to the milk that was way in the back. That milk would be disgustingly sour if they keep replacing it and they don't sell all the way through it. So that's last in, first out. The most recent things are the first things sold. I also think about tech industry, even though they don't stock shelves, right? Older things don't tend to go off the shelf. It's the new stuff that's flying off the shelf. So those are the cost flow methods. Revisit those a bit. People don't tend to have an issue with them, really. I think people have it more of an issue with this idea, the cost flow assumptions, and that they don't have to relate to the physical flow of goods. I can assume whatever I want. And also they have a little bit of an issue thinking about, oh, it's only affecting my sales. It's only affecting my debit to COGS, my credit to inventory. It does not affect at all my purchases. All right. So that's where we'll pick up next Tuesday. Like I said, I extended the Smart Book to Sunday, I believe. And I need to look at the due date for the assignment number 9, and likely I'll extend that as well, at least until Wednesday. Okay. So hope you guys have a fantastic weekend. If you haven't taken the test, best of luck in preparing and getting ready for that and taking it. And other than that, yep, great having you. Thanks for showing up, and I'll talk to you guys soon.